Hey everyone, welcome back to the weekly recap for April 20th through the 26th, 2026. If you've been watching Wall Street lately, you're probably noticing a bizarre tug-of-war playing out on the trading floor right now. Before we get into it, a reminder that everything discussed here is for educational purposes only, not financial advice. Take a look at this chart tracking the major indices. We clearly see both the S&P 500 and the NASDAQ trending sharply upward, hovering right near all-time record highs. Looking at this alone, you'd assume the economy is perfectly healthy. But outside the trading platforms, global headlines are dominated by escalating military conflicts, rising tensions, and stubborn inflation fears. Which brings us to the biggest mystery of the week. Why exactly are stock prices pushing toward new records, while at the exact same time, investors are pushed to the brink of panic? To understand this disconnect, we have to look at the macroeconomic forces pulling the market downward. Much of this pressure originated from recent actions taken by the U.S. government. Midweek, we saw a sudden, sharp drop in the markets. This sell-off was triggered directly by news that the U.S. military seized a ship linked to Iran. Adding to that tension, President Donald Trump shifted his tone this week. Any earlier hopes for diplomacy vanished as he signaled a much tougher stance on Iran, injecting a fresh layer of unpredictability into the market. This chart shows the immediate economic consequence of that specific conflict. Look at how crude oil prices are violently fluctuating back and forth within this highlighted band, swinging rapidly between $95 and $105 a barrel. When oil sits around $100, every single part of the supply chain gets more expensive. Traders are nervous that these sustained energy costs will keep inflation high, which forces central banks to keep interest rates elevated just to cool the economy down. Put simply, this combination of global instability and expensive energy acts like a heavy economic gravity. It threatens to choke off global growth and drag the entire market downward. So why hasn't everything collapsed? Because there is an equally strong opposing force pushing the market back up. We are seeing surprisingly resilient corporate earnings across the board. There is a deep irony here. The exact same high oil prices that terrify regular consumers at the gas pump are driving massive, consistent profits for the major energy companies. The second pillar holding up the indices is the technology sector. Artificial intelligence and semiconductor companies, in particular, remain incredibly strong, acting as steady growth engines for the broader economy. There's a simple economic logic behind this. When the global outlook is murky, large institutional investors seek safety. They pour their capital into businesses that are generating guaranteed, immediate cash flow right now. The stellar financial results coming out of tech and energy are essentially acting as an artificial safety net. They are single-handedly keeping the major index averages high and preventing a broader market collapse. This divide is causing a fractured reaction across global markets. Regions heavily dependent on importing oil are struggling with rising costs, while energy-producing nations are seeing steady gains. When these two massive macroeconomic forces, the fear of war and the reality of record profits, collide head-on, the result is deep paralysis among institutional investors. Even with the excellent financial reports we're seeing, a huge portion of Wall Street is choosing to sit on their cash. They simply refuse to take on large, aggressive risks, while the geopolitical situation remains so fluid. This shows that the market isn't actually as healthy as the index averages suggest. It is temporarily stuck, reacting wildly to every new headline because the underlying data is entirely contradictory. If there is a lasting consequence to the events of this past week, it is this. Extreme, headline-driven volatility is officially the defining theme of the 2026 market. We can visualize the market with this model. Notice how the trend line bounces along this lower barrier, strong corporate earnings acting as a solid floor. But adding geopolitical fears creates a heavy ceiling. Market growth gets trapped, becoming erratic and tightly compressed between profits and panic. Until there is real clarity regarding global conflicts and inflation rates, the trading environment is going to remain incredibly fragile. Every new development carries the risk of triggering sudden sell-offs. Those record highs on the index charts are masking a deep underlying unease. Right now, Wall Street's primary strategy is extreme caution over aggressive expansion. That wraps up your market recap for the week of April 20th. I want to hear your take. Do you think the markets will manage to break through that ceiling to new highs, or are we facing a major correction soon? Let me know in the comments. Thanks for watching, hit that like button, subscribe for weekly updates, and I'll see you in the next one.